college sophomore as well from Michael's alma mater of Boston University. And this is different. And this is certainly going to be a defining and transformative event for everybody. So what I thought I'd do today is just, like Michael said, introduce myself. How many of you guys were at the January events at NASDAQ, which again seems like, I think I see some familiar faces out there. So good to see you again. It does seem like a world ago, and that's one of the things that I thought we could talk about is in the context of the markets, what's changed? How does this rhyme or seem similar? How do you manage through it? What am I hearing out there from the corporate executives who I work directly with? And also, what am I hearing in terms of opportunities? How that can also tie into you guys who are at least thinking about a career that could have something to do with finance. So please raise hands, questions along the way. First thing I thought I'd do, first, let me give my background. So Rob Phillips, I'm a managing director with NASDAQ on the listings and corporate services side. So my job is to work directly with executives of public companies, mostly NASDAQ, but also New York Stock Exchange listed, and to work with and pitch on the NASDAQ listing as an exchange, as well as all of the ancillary services that companies use. In essence, to enhance their experience and impact as publicly traded companies. I've been on the street longer than I care to think about, so about 25 years. I also attended a small liberal arts college, which if memory serves, your president also went to Hamilton College. And so I graduated from Hamilton in 1991. And our CEO, by the way, who was just updating all of us, is also a NASDAQ graduate. She went to Williams and is also class of 1991. So look, there is a lot of overlap and a lot that we can talk about in terms of the disciplines that you guys focus on, and number one being communication. There is nothing more important right now than communicating. And we're going to get to that, even if the answer is, I don't know, because frankly, nobody does or legitimately should or would in this kind of market. Quick background, 10 years at NASDAQ. Prior to that, I worked for a portfolio management firm that included the 2008 credit crisis. This feels like it rhymes with that. So we're going to spend a little bit of time on what's feeling the same, what's different as well. Prior to that, I traded bonds for about 10 years in an open outcry technology enabled or assisted method that's in essence gone, but we replicated for fixed income what the New York Stock Exchange floor did for stocks. Can't resist, by the way, the NYSE floor is closed right now. There is no more pretense to the human interaction to that. And then way back in the day, I did work at the New York Stock Exchange. And prior to the New York Stock Exchange, and let's see if I can do my virtual background here. I worked with, okay, who's that? Who's that in the background? Can I see myself? So that's me in the Coast Guard. So that's what I did in quick sojourn after undergraduate. I actually enlisted in the Coast Guard. Let me put my NASDAQ background. So that's me in a nutshell. And again, my day-to-day job is working with the executives of the public companies. There is an awful lot to talk with them about. So if I can try to present the screen, Michael, I'll start with what I'm telling.
You should be able to share your screen.
Oh boy. Didn't this cause the problems last time with you and me?
And I'll do it. If you want me, I can show you slides.
I'm going to share the screen. But look, in essence, I'm covering about 150 currently public companies working directly with their executive teams. And to a great extent, they all feel like they're spectators to their own businesses and to the markets right now. And to an extent, that's very true. Right? What is transpiring in the markets is more macro than micro. It's more in the overall economics than it is, or the market fluctuations than it has anything to do with their fundamental businesses. So step one I do, and I'll do it with you. Now I'll present the desktop is, we're going to talk about what's happening in the markets right now. Can we put this into some context? Is there some historical context to do it? And I think we'd even done a lot of that when you guys were down in New York a world ago. Okay, here goes. Are you guys able to see my screen? Oh, wait, start sharing. Okay. So far, so good. You guys see my screen, by the way?
Yep.
Oh, no kidding. All right, that actually worked. Guys, what we're looking at here, and by the way, back to what I did in 2008, when I was working for a portfolio management firm, it was a long-short hedge fund strategy, fund to funds. So we took in assets from institutions, pensions, endowments, foundations, and we put them out to about 40 different hedge funds that enacted two basic strategies. One was long-short equity, and the other was event-driven. Today we call it activist, but it was fundamental, bottom-up, deep value research, and it's all about benchmarking yourselves. In other words, what's the market doing? That's your beta. That's what I'm talking with the executives right now about. It's beta. The market is going to dictate what your share price is, and there's very little about your fundamentals that's really going to step in. Even if there are some positive stories out there, it's really more about the story behind the sector. Are you logistics tech-enabled type of company? Are you a traditional, let me see if I can be cryptic here, a public company that may or may not own about 100 cruise ships? What does business look like there? These are particular to you, but also the overall economics. But at the end of the day, this is what I tell them. You're an alpha generator. If beta is the market, then alpha is how you outperform, either the overall markets or relative to your peers. And there's only two things at the end of the day that investors care about. And that's, where did I buy this investment, whether it's a fund, and we'll talk about some of the funds you manage too, or your stock, and where's it today? And by the way, if you're up 10% and the market's up 20, should I be happy with that? This, by the way, that we're looking at, and you can see where I'm pointing to, this is the S&P 500 roughly since Michael and I have been working professionally. So I graduated undergrad in 1991, and this is in essence what the S&P 500 has done. When I worked in a portfolio management firm, this is your classic benchmark. This is what I'm always steering the public companies to. It's the 500 largest cap companies, that public companies in the United States. And it includes foreign headquartered as well that are listed and traded here in the US. It's a very good cross-section of the global economy and the US capital markets. And it would be the benchmark that I would tell everyone to compare themselves to. Dow Jones, that's only 30 companies. It's been around the longest, so that makes it a good, relevant historical benchmark. NASDAQ, that's 100 as opposed to 500 companies. And although it's evolving over time, it still biases towards technology and growth. So if you're picking your classic middle of the road overall barometer of the US economy and global economy and capital markets, this is it. And this is what it's showing. So there have been corrections along the way, as you can see. So this is your dot-com bubble. This is when growth began to completely overtake value. And it was a point in time that I would say about 5 years, from about 1996 to 2000, where I'd say public private equity companies had come to market and were trading at valuations that were very, very difficult to reconcile when it came to a value approach. Correction. About to 2002, 2003. S&P 500 found it came back to about late 2008, and then the credit crisis took its toll as well. This has been one of the challenges, by the way, guys. What's that? Any questions? Jump in with them, please. Or I can talk for an hour, and I was telling Michael, say absolutely nothing. But what we're seeing here is the overall cycle of a market that has a general trend up. And to the extent that history can predict the future, one of the things it conveys to me is that it's one key metric of the overall aspiration for us to develop, build value, create value, and grow. And history tells us that in the overall happens, but there are challenges that take place along the way. And when you see them, they behave like some of the other ones have. And when you're in a market like this, it's the overall macro story taking over, and a lot of it expressing itself through trading as opposed to investment. From my own personal if you can't time a market, then you're not a trader. And the three legs of the stool that I talk with about the public company executives, three basics to simplify the nth degree. You run a public company for a living, you own it for a living as a long-term value fund, a pension, the Colby College endowment. These are long-term buyers and holders. But the third leg of that stool are those who transact for a living. And it's been a difficult 10 years for them because there's not been a lot of volatility since about early 2009, and now there is. So those who transact for a living are able, presumably, to do well in a market like this. But I can tell you from NASDAQ's standpoint, we just reported earnings yesterday. 1/3 of our revenue is maintaining exchanges globally. We own 30 exchanges in Europe, Asia, and North America that trade a broad array of financial instruments, and there's been a lot of activity. Not only a lot of activity, but a good percentage capture for NASDAQ. So whether or not the traders are doing well, they're certainly active in a market like this. And it's to the benefit of a company like NASDAQ that's in the business of connecting buyers and sellers. Back to the exchange, to the screens here, we're seeing that the markets overall trend up and have corrections in them. It's hard. I know it's hard for me, and it's hard to avoid doing it, listening to the headlines all day about how bad the scenario is, about how markets are cratering. If you can pull back and take a historical perspective, we can see that this certainly is not unprecedented, and that's what I'm trying to explain here. Now, a couple of things. All right. By the way, did my screen change here? You can see the second. All right. So we are certainly in the COVID environment when it comes to the markets and to the valuations and globally as well. It took over starting in early March. And as you can see here, that's a significant gap for the S. And everything I'm showing you here, by the way, I tell you otherwise, is the S&P 500. But one of the things that may have triggered it, and at least puts it into some fundamental economic context, is there was a service sector, a service sector economic number, PMI, and it came in contractionary in late February, and that's what we're showing here. There may be, and I think there have been, some contradictory numbers that came out after that, but the market had already rolled. So one thing that I'm also telling the executives I work with, in addition to the fact that this is a macro environment and sometimes macro rears its head, there was an actual economic report that indicated that while, even though the manufacturing numbers had been weak for a while, the service sector economy was indicating continued growth, and that was to an extent carrying the markets. It was certainly driving a lot of service sector businesses and their earnings, and it indicated for the first time that that was beginning to weaken and waffle as well. And it can be debated, but it's out there that there is at least one fundamental economic trigger that started all this. And then I would argue that the COVID markets have taken over. So what now? What can you expect? You know, I was catching up with a client who at this point is a friend, and it's a very challenged kind of business. And you're sitting on your hands. By the way, it's the whole of the market. If you as a public company executive watching your shares crater, well, when I ran a fund, your job was to invest in managers or well-run companies. Well, they've got to mark their books. They've got to mark their investments. What's my investment worth right now? So if you're calling your institutional investors, they're also dealing with their own concerns, and they have to communicate to their investors as well. That's a good context to put it in. But what could we reasonably expect? Well, first of all, best answer I can give you is no. Okay, and anybody who is doing super well in this market would probably not be advertising. But we do know that corrections have a certain pattern of behavior. For those who are more technical among you, and this is what our market technician is illustrating here, is Fibonacci retracements, Elliott wave theory that says it can be observed historically that markets move in longer term, but also in shorter term markets in 5 waves, up, down, like 5 waves. And that's basically what we're seeing here from a trigger is the classic and the historically observed market corrections, like the ones we've seen along the way here, have a couple of basic steps to them. One is the initial fall off the cliff drop off, which we had. Once the markets were digesting in real time that we were in fact dealing with a pandemic, and it seems to be unfolding there now, is the capability to slow and or stop the global economy, then you've got a market that severely corrects, which we have. Other corrections historically tell us, though, we go in 5 waves, 5 different waves, or sorry, 3. Down, you retrace some of your losses, you revisit the lows again, and then you climb back. Another thing that technicians would tell you is your resistance from prior time periods. You can go back as far as 10 years, and we do it with some stocks. It will act as resistance, and in this particular case, in the market that we're in, what becomes resistance then becomes support. We've also seen that play out in the current correction. Back to this. Markets, if they're in free fall, which we've now seen, and I think we've gone through the free fall and the price discovery. If you're the CEO of NASDAQ, and she was stunned, let me look at our share price right now. So we're trading at about $103, $104 right now. We were about 110 last week. Late February, 120 a share. We saw as low as $70 intraday in the midst of this. Markets falling off a cliff, and they're looking for their price discovery and for their support. And then key support, once it's broken through the support, you got to find the next level of support. And I'm sorry if I'm jumping back here, but we've seen this play out in the overall markets, that once you break down certain resistance or support, the market goes looking for the next levels of support. We had a stock that went as low as $70 in the price discovery period, and that's what we're depicting here. This isn't NASDAQ, but this is the S&P 500, guys. The big question right now on April 23rd, when it comes to the global and the U.S. Equities markets, is this market going to roll over? Is it going to test its lows? We hear a lot of talking heads on that. And by the way, I'll do a bit of a commercial here. The old trader adage, by the way, is when CNBC is on the trading desk, it's on mute. If you need to listen to what's actually going on in the markets and turn the volume up, everybody watches Bloomberg. And the prognosticators on all of them are saying, look, the big question is when you have a correction and a price discovery fall off the cliff, the kind of thing that would see a NASDAQ, for instance, trading at 120 up here in a nice tight band. Look, the other thing that we're depicting here, and this is a daily price movement, is that even visually, you can see there's not a lot of volatility here. And if you trade for a living, volatility is the key component of being able to profit from providing liquidity. You can even see visually how much volatility has come back into this market here. And that if you're also trying to think directionally and how this is playing out, is now we are 2 months into this global pandemic mindset, and we're beginning to see some of the real impact that the stoppage and slowdown has on actual real businesses. And that's going to play out. If you're thinking technically, and if this is a correction that behaves like others, then you can expect that you're going to see that you're going to go revisit the lows. Again, that's what has happened here. The question is, if in a classically behaving correction, which by the way, when you're down 35% from the top to the bottom, that certainly counts. But we've climbed back about halfway, and we're there around now. The S&P 500 is about 28. Sorry. Yeah, about 2,800 right now. So we're floating in around the retracing of half of what the fall off was, come back half. And if it behaves like others, we find that low again as reality begins to set in, and you then begin to find your footing, if you will. Back to 2009, that in essence is what happened during the credit crisis. It was very quick. It was certainly severe, but it was a market that had a drop off. We call it a relief rally, and that's the question right now: is this a relief rally, and if so, how far do we go back? And then how do we revisit the lows again? Now back to the conversations that I have with those who are operating businesses. This is usually where I turn to them and I say, okay, tell me how things are. Tell me about your business. Again, if you've got a restaurant type of business, they're thinking about the other side of this, and they know it's not going to look anything like it did. You know, when your business model is basically trying to cram as many people as you can into whatever facility or space you have at once, that's not something that's going to look anything like it did. And now we begin to get into the sector-specific part of this. If you're a technology company, or I had a conversation with a staffing CEO, and they provide a lot of temp tech staffing to legacy and technology companies. Well, they're uniquely positioned to benefit from a stay-at-home work environment. All this to say, when we're seeing the relief rally seem to have found, at least for now, its resistance, reality setting in, we're going to get some understanding about who's going to do better than others in this kind of environment. So I could stop there. Any questions in the overall? Cool. What we're depicting here is, again, in a trader's paradise, one of the things that we were observing and passing along to our companies is every time the S&P has been rallying, it's basically been failing at the gap from the prior session. These are just all meant to provide some context to those running businesses who don't trade for a living, that it's that trading in macro and headline-driven environment that's taken over, and just more of the same. And again, guys, to repeat, a low volatility market that was doing well. And by the way, I had a conversation in late February with a professional board member, and she's on 4 or 5 different public company boards, and different market caps, different sectors, a lot of disparate businesses. And I asked, how are things? And she said, things are going well. You know, customers are buying. We think we can predict the future right now. We don't know what this COVID thing is. None of us did. It's amazing how quickly that all turns. But prior to this, the sense of confidence in the overall was very apparent. And it was apparent across just about every sector that I was working with. And that conversation was certainly one example. More scenarios. Big question. Again, can we expect I think the way I'm putting it to the business executives again is if we revisit the lows from here, it certainly has precedent. It's certainly something that can be expressed historically, and there are almost positively traders out there who are positioning the portfolios, and we're beginning to see some of the evidence of that. We have pretty good insight into short, and I'm going to be asking about your own strategies. Short interest is spiking up in this. So that, yeah, please.
We have one question. Somebody has a question.
Yes, I do have a question like a couple minutes ago. Would you mind, or I can definitely wait for another while to bring up the question.
Far away. I love this.
Yeah, thank you. So as I understand, S&P 500 is more like a reflection of the stock market, like how well the stock market performs, right? So I understand how the stock market is quickly kind of like reacting or adapting to the new circumstances. But I'm just wondering how much does manufacturing take up the S&P 500? Because as I would imagine, a lot of productions are going through a lockdown.
Yeah.
And I wonder, like, because what I imagine with production is that they cannot react or adapt or recover this fast. And I wonder how much of that impact on the stock market or the economic as a whole.
So that's a great question, and I'll answer this more as Rob than NASDAQ, because first of all, the answer is who knows, and it's certainly not our business. I'm beginning to wonder, with the kind of relief rally that we've seen, Isabella, is the market disconnecting from reality here, right? We're seeing price and we're seeing trading movement, but to your exact point, we are not going to see, or we're going to certainly see disruptions in what I'd call more traditional businesses and manufacturing among them. We are going to start to see separation by sector and separation by, I would say one is sector, two is going to be the balance sheet, so the finances relative to the others, and the third is just going to be in the overall, who's a stronger performer relative to. One of the things that I saw, now going back to 2009 and 10, and to your point, was the quick market movement was about the overall. The initial relief rally was about overall, and then investors began to get particular about sectors. And you saw entire sectors of the market get fired, if you will. There wasn't really any bid whatsoever for home builders in a market or in an environment like that. The manufacturers and the entire supply chain in and around them are the kind of reality, to your point, that has me wondering just how long this relief rally can possibly last. Because we are certainly going to see disruptions, and I'm seeing them in real time. I'm not seeing as much in manufacturing yet, although I'll admit I don't work with that many manufacturing-based companies, and not at the global scale. But the travel and leisure, I mean, there's another one. I had a conversation yesterday. We're talking zero revenues right now. I don't know how you put a valuation on a business that has disrupted supply chains, disrupted manufacturing process, or assets with no revenue. But we're certainly going to see. And then that one of the topics I thought I was and this could be a good time to bring it in. So please, guys, keep the questions coming. What's this look like on the other side? Who's excited right now? The entrepreneurs who see disruptive technology, especially technology that's going to be cost savings, anything that has to do with life sciences, in particular pandemic focus, that is going to help us solve the immediate problem. And the third in the overall are distressed investors. Distressed investors have been sitting on the sidelines of I would say this is a 7-year bull market. Let me go back here. I wasn't declaring the bull market in 2009 or 10. the way they do in the news. I began to declare it in about late 2013. Why? Because you actually found and broke through the resistance of the prior two tops of the market. Once you do that, you set a floor, and there's your bull market. During this entire bull market, the distressed investors have not had a lot in the overall to do. They are about to. And you are going to have, and manufacturing would be a perfect example, a lot of great assets and capacity and product and technology sitting on bad balance sheets. I hope this time, although I'm not sure, that the ones who are have weaker financials but good otherwise assets are going to be allowed to roll over and get onto better balance sheets, and that's exactly what distress will be looking to do. That plays out differently, Isabella. So to your question, this is the equity market. I focus on it because I think it's a better overall pulse, and because look, that's the world I live in. But when you see distress, what's the way to express equity ownership in a distressed asset, and especially one with too much debt? That's a question back. Anybody can answer that. In other words, if I see a highly distressed company not getting any direct government infusion, that's another one. Great asset, bad balance sheet, and just that. I see assets that are worth more than the share price is trading right now. Would I buy the stock, or would I buy the debt? I'd buy the debt. Right, because who gets wiped out when a company goes into bankruptcy? It's the shareholders. That's the risk you take. If you are a distressed investor, you're looking at the cap table, at the balance sheet, and you're seriously considering about investing in the debt. And by the way, if you're seeing this kind of movement in equities, what do you think distressed is doing? What do you think debt is doing right now? It's trading at pennies on the dollar. It's flushing out the long and strong holders who've been looking for kind of yield but didn't bargain for a less than perfect environment, and they're going to be stepping in. It's going to be very interesting to see how that unfolds, and particularly with all of the central banks, plural, and the central governments, plural, stepping in to right or save sectors and specific businesses. So any other questions? Okay, so that actually it leads me to one of the next things I was going to talk about. Any guesses to what that is? I don't know how clear that is to you guys.
West Texas index for.
Ah, you can see. Okay, yeah, that's energy. Now let me tell you something. All right, there are going to be a lot of distressed companies in this kind of space. Not knowing the specifics, but this is a business that lends itself to a lot of debt capital, and it needs a commodity somewhere around $50 a barrel for the heavier stuff, probably $30 a barrel for the light sweet, which I think West Texas intermediary is. And did anybody catch what happened with oil on Monday? Seems like a world.
It went to negative territory.
Negative. So what does that mean?
Like if you buy the May contract and you have to, the price is negative, you have to pay someone in order to take your commodity over. Yeah. Yeah.
How about that? I'm buying a commodity and somebody's paying me. I mean, so basically, okay, how many barrels in a contract? I got some room in the backyard. So I can go long a contract and be paid to take delivery, and it's on the spot. The other thing that I've been having some conversations with oil types is, what are the longer dating contracts doing? 6 to 24 months out. How are they priced right now? One of the key strategies for commodities traders, brokers, intermediaries, by the way, is you trade the spread between 2 years out or 6 months out and spot. The spot, and these are all spot what we're talking about, where you could get paid to take delivery. What's that about? Because this is going to have the implications working through the entire economy as well. Why would, on the spot, the sellers pay you to take the oil? The answer is there's no place to put it. They've literally run out of places. I had a call yesterday, for instance, where somebody said, we have a super tanker at anchor. And the tanker company is saying, look, we're not in the storage business, we're in the move business here. Tell us where to take it, because we're going to offload this oil. There's no place to put it. That's why in the spot. The question then becomes, in the overall economy, is 6 to 12 to 24 months out, if those contracts are holding up, and the expectation is once we get past to the other side of the COVID environment that we're in, of the social distancing, and we can get back out there, cars start driving again, to an extent people get on airplanes, that all of the inventory literally gets burned through, and then we're starting to get the process, the economy, the cycle rolling again. Energy from this standpoint has always been thought of as a leading indicator. And the tell is what it looks like heading out there. To that point, and this was just one of the observations that our technician said, that from that standpoint, the energy-related stocks are holding up pretty well as the underlying commodity has gone into negative territory. Last thing I'll say here is this was a conference that a coworker of mine was working on today with a bunch of states' treasurers. And the state treasurers are the business people for the state. Most elected, not all, but most are. And the key question is, what does the economy look like in our states? What does transportation look like in all 50, every territory, every area? A key part of it is just travel, tourism, and it's business conferences, it's large scale travel, it's cruise ships, but it's also individual salespeople like myself said, I'm going to take 2 people out on the road and we're going to hit a territory, fly down there, buy dinners for ourselves or clients, Uber, Lyft and Avis. I got to stick with the NASDAQ listed companies, guys. Staying in hotels. That is all on hiatus for now. So what does this look like and how does this express? Well, what we're seeing here is the S&P 500 in the current year-to-date environment, the rollover here, and now we're beginning to see the differentiation between the sectors.
You have one question?
Right? Yeah, please.
Victor?
Oh, yeah. So, hi, Rob. I have a question about so we know that this, as the oil price went to negative territory, it's have a huge impact on the oil producer in the U.S. And how do you see what's going to happen to the whole oil industry? How is this going to change the landscape of the oil industry? As we know, prior to this, we already have an oil pricing war between started by the traditional oil producer like Saudi Arabia and Russia. So how do you think this is going to disrupt the whole landscape? And do you think the American government going to help the domestic oil producer to kind of bridge this gap?
Last question first, yes. Right, that's the expectation. And I'd be surprised if it wasn't the case. From my standpoint and from our understanding is what has begun to play out with the energy was already well underway. And by the way, that's been a general sentiment from little deals to overall sectors is things that were already in motion stayed in motion and accelerated. What's been happening in the energy sector globally is more technology for production, alternative sources of energy, more fuel efficiency. In the overall, the global dynamics of fossil fuels really have been changing. This has accelerated that. Yes, back there was certainly from every country be government support for the sector, but nothing's going to change the innovation that is already underway here. And by the way, we had this exact same question in 2008. Now, 2008, what was different? Interest rates taken to zero, and oil was $150 a barrel. And that was about flow of capital, but also fracking wasn't even a thing in the States. So the U.S. was a net importer of oil. Now it's a net exporter. I understand it's a net exporter because the refineries aren't even geared to be able to refine the light sweet stuff that is brought from as far down. All this to say, again, we're going to see, we're in the midst of a global transformation. How it's going to turn out, who knows? And I think there's going to be a lot of distress investing here. The oil exploration companies, for instance, in the U.S., and if you want to follow up, I'm going to speak to a Canadian investment banker next week, and they spend a lot of time on resources, in that country. Their challenge is the oil that gets pulled out of Alberta is much heavier, much harder to refine, and takes a lot more capital to extract from the ground. We're going to see some distress in there, and maybe less and less of an inclination to support an industry like that. I'm sorry, does that answer the question? Yes.
Thank you.
Yeah. And by the way, the last point here is this trailer down here. That's airlines. That's the airline stocks. And that's going to be people like me, guys, saying, you know what, I can do this. Just think of how many different geographical locations we have on this call. I don't need to be in the region anymore. And what's more, clients may not want people, especially from the Northeast COVID hotspots, visiting them if we can just do it like this. Airlines, the airplane manufacturers, this whole thing is going to be very different. And that's a sector that I think everybody's trying to figure out right now. So cruise ships, forget it. I don't even know where to begin with that. If I was distressed, I wouldn't even know what to put a valuation on that. And that was my own personal inclination. Hell, I was in the Coast Guard, all right? We scrubbed every millimeter of that vessel, and we still had every injection you could possibly imagine, and you still had these kinds of issues. I don't think there's going to be much interest in packing yourselves in. So restaurants, cruise ships, airplanes, the entire model depends on packing as many bodies as you can into as limited space, and to conducting your business as cash efficiently as possible. We're already starting to see that these things are going to start trading a little bit differently as well. So that's any other, sorry, let me look at my notes, because one of the other things, that I thought I'd talk about is, all right, so we just spent about 45 minutes discussing where we are, kind of how we got here, what we might be able to expect in the short term. If you're thinking longer term, thought it's worth talking for a few minutes about what does the other side of this look like. And for you guys who are in the university setting and thinking about careers and could be in finance, what would the opportunity be here? Have some of the assumptions that you made been upended for now? And I think they have. Well, I'll tell you who's getting excited about this. One of them is distress, which I mentioned. Distress is an opportunity to take innovations off of weak balance sheets and put them onto other ones. And it's an opportunity to get valuation once you can get to the level. This is the challenge right now, guys. We don't know what the valuations are. We don't know what this looks like in 6 months. We don't know if this is something where we're going to be able to social distance ourselves for a period of time and then come back like this. Hard to put a valuation in a setting like this. That's an opportunity as well. The other ones who are getting excited right now, one I mentioned, they're the biotechs. So I'm going to have a conversation after I wrap up here with a biotech serial entrepreneur who could not be more excited about what he's seeing as a combination of innovations that are going to get capital and focus, and ones who've got good science but been very bad about telling their story. He's very adamant about that. Overall life sciences. The combination of the innovation, the capital, and the ability to explain it, which is something that cannot be discounted ever in any kind of market, is how do you differentiate your passion, your innovation from others? It needs to be explained. Even when things are going well and the tide is rising, you're never really in an environment where you can just run your business and not explain how you do it, what you see as the opportunities, and what the value proposition is for people deploying capital into your ideas. Anything around biotech. And then the other one is overall just innovation. I had a conversation, he actually told me to mention him. Here's a guy, to personalize it. His name is Sultan Megji, Sultan. And Sultan's business is Neocova. Neocova's core business is providing a technology stack to community in regional banks and to credit unions. And when I go out in the field, guys, let me tell you, of the 150 public companies I deal with, 50 are financials and 30 are community and regional banks. They live in the neighborhoods, in the regions that they service, and their technology. I think they all know one of the key challenges they have is the current crop of up and coming people that you bank are banking on technology, and the technology that's provided to them is mediocre. There are some legacy incumbents out there. It's expensive. It's long-term onerous contracts. It's everything you wouldn't want to do in this kind of environment where you've got to innovate and move quickly. Well, these guys are looking to solve that. An environment like this, where, by the way, interest rates have been taken back to zero. It's not a great environment from a deposit lending from that standpoint. So you need to conserve capital. You need to think it creatively, and you need to have good technology at reasonable prices. That's what they're doing. This is accelerating their core business. The other thing is they're finding their way into the artificial intelligence and the data and analytics that their core business is throwing off. What Sultan said to me is the great businesses are all born in fire, right? So if you haven't read a book called Built to Last, then I recommend it to your reading. It's the kind of thing that you'll be through in a weekend. I read it in business school 20 years ago in my entrepreneurship class. The whole point of Built to Last is it compares companies. The Disney's versus a company you never heard of. The Hewlett Packards versus companies you never heard of. And one common thread is they were started by people in challenging times. And that's what Neocova is beginning to think, that the world is getting huge from their standpoint as the need for what it is they're delivering in the core becomes much, much more apparent and more critical, which everything does. Like, if you have a pitch that's better technology at a lower price, and add that to a distressed environment, it's starting to resonate. From my own personal standpoint, guys, I am not missing any opportunity in this market to go back to every company listed on a competitor exchange that's paying 4 times what we would charge and say, is now the time to bring this up? Stock's going up. You want to pay 4 times as much, great. But if you're calling and asking for relief, why don't we actually have a real conversation? It's similar to that. This is an opportunity to restate a value proposition, a superior value proposition at a superior level. And then the other is a mindset, constant communication. One of the things I'm being asked about is, how do you communicate in a crisis? What do you communicate in a crisis? Well, up until February, if you were a public company and you were suspending guidance, right? Because that's then the market mindset that we're in, is it's not just tell us how you did in the most recent quarter or the most recent year, but the appetite was for some guidance on what you think the next 1, 3, 4 quarters looks like. In this market, the best line I heard was on Bloomberg yesterday, where one of the reporters said, why would anybody even try to provide guidance in a market like this? Nobody would believe it. All that said is communicate, even if it is I don't know what this market looks like, but let me communicate what's working in our business. We have a sound, solid balance sheet. We have a core business that's undisrupted, even in this disrupted environment. We have good logistics chains, and we have very, very good insights into our ability to get supplied by our suppliers. We have a business that's been migrating to an online delivery model, and this is accelerating that. And we have a core group of committed professionals at every level who are keenly focused on the business. These are things that you can communicate, that there's going to be an entity that exists on the other side of whatever this is. But don't try to predict the future. Frankly, my own personal opinion was, I understand that there's a setting in the market that calls for guidance, which is a guess, or as my late father used to call it, swag, scientific wild ass guess. But all right. But also understand if there's an environment that says you can forego that for now, because you won't lose points for doing so, but you can still convey and communicate in a crisis, if nothing else. And I think we're seeing this, I know I am, play out with a lot of our public figures. There are those that are saying things like, I'm scared too. I've never seen anything like this. I know we're going to get through this together. The ability to communicate and convey and reassure and reinforce that can't be understated ever, but especially now.
So thank Rob. So we have about 5 minutes left.
Yeah.
I want to encourage the group to ask any questions now because we've scheduled to finish at 4. So.
And no softballs, please. Keep them coming. Put me on the spot. I love hearing it.
Please don't make it easy on them.
If you want to lob a meatball, I'll bat it out of the park, but now's the time to ask. Fire away. Sorry. What's your name, Pidan?
Hey, Rob. How are you?
Good. Good, thanks. How are you doing?
Quick question on the IPO markets in the future of what do you think for big companies like Airbnb, who just recently did some financing at like 10% debt level. So I wanted to see what you thought on big companies like those, but also some smaller ones that are they going to wait, like hold off for the near future? What are your thoughts on that?
Yeah, it's easy. By the way, where are you hailing from?
From Massachusetts, from Southborough.
Nice. So the quick answer is, man, IPOs, no. Full stop, right? And Adine, our CEO, said as much, diversified business. Trading is great, IPOs, right? We brought 2 in the last month. They were both life sciences, and let me tell you, they were not the great, big, shiny brands that you out of Silicon Valley that you would that you'd focus on. They'd have come public and nobody would have noticed. In this market, I can tell you, we are minimum 2 quarters. Nobody is going to lose points for holding off in this market. And frankly, we were already seeing that in the beginning of last year. Wait and see, just like no guidance. This is going to be a very quiet market. Now we can get to the specific sectors. I wouldn't want to be in an Airbnb business right now. I wouldn't want to be in a business that, so now we're talking private equity, right? The Airbnbs of the world, the larger cap, well-backed ones have been able to go get as much capital as they want from the private equity. It's going to be interesting to see if they can do that.
Alan?
Yeah. Hi, Rob. Thanks for taking the call. So I work with our school's investment association, and we do long-only equity.
Okay.
And earlier you said that this current crisis kind of rhymes with the 08.
It does.
And after '08, we saw like stunted GDP growth for years afterwards. Are you predicting some kind of larger macro effect like that after this, or do you think we might actually rebound in the pretty short term?
It's too soon to tell. And by the way, my answer to your great question comes from our own economics team and trading team. We just don't know what this is going to look like on the other side of this. The key difference between '08 and now is it was finance that caused it in '08. What's different now is this has come from the slowdown in the real economy out there. I also can say this. The market found its bottom in March of '09. The economy remained stunted for a protracted period of time. And the markets did find a way to go up because they're forward looking. When it comes to the investment strategy, and especially a long equity one, is the understanding that valuations will drive market movement, even while the economy seeks to find its longer term growth footing. I think we're going to see something like that again, because you just think about the disruption that we're seeing right now. How could it not have longer term impacts?
Yeah, thank you.
Sure. The other thing I'd say too is, I always ask in business, what's the coiled spring? I'm still hopeful that the coiled spring here is everybody wants to get back out there. Everybody wants to get back to work. Everybody, lenders want to lend. People want to travel. That's a coiled spring. There'll be impacts, but it has the potential to get everybody back out there again. And again, remember, markets are forward looking.
Maybe we can squeeze one more question in. Muxin?
Hi, Rob. So there's
How
a
you
company.
doing? Where you calling from?
I'm sorry.
Where you from? Where you calling in from?
I'm remaining on campus.
Oh, that's great. I'd love to be in Maine right now. Fire away.
Yep. So I have a question. So there's a company called Torm, which owns and operates produce tankers. And then I noticed that 2 days ago, its stock price rose from $7 per share to about $36, which is like around 460% increase. So I wonder what are some like possible reasons that happened.
No idea. Wouldn't even want to venture a guess. All I can say is good trade.
Yeah, do some research on. I think it definitely has something to do with the recent oil.
It's a tanker company, but not oil related.
Nope, it just owns and operates.
Yeah, it's a great question, but I can say in general, you're going to see a lot of this.
Yeah, and the price.
You're going to see a lot of inefficient price dislocations that could be taken advantage of or could burn you.
Mm-hmm.
And that is entirely consistent with the market correction and an overall macro story. We've also seen, just very generally, a lot of stocks will trade with an overall trend, even though they're not related. And that's just the sloppy kind of price discovery environment that we could be in. And a lot of it's algo driven. Tanker stocks would be thrown out with oil. They would. And it's entirely I can absolutely picture where a tanker stock that has nothing to do with oil would be thrown out. We call it the baby with the bathwater. But I can't get more specific than that.
Yep.
I'll be on the lookout for the next $7 stock that goes to $36.
Yeah, I think it now
on the wrong side of it, but
back.
that's more Rob talking.
Okay, we're at 4:01, so I don't want to extend the meeting. So
Well, I have another few minutes if there's any other questions, but look, I'm always available. If everybody just wants to, any questions, any thoughts, I'm always standing by. Happy to do it, guys.
I think we have one. Victor has one question. We can see that. And anybody feel free
Yeah,
to
Victor, fire away.
Yeah. Hey, so my question would be, right now, we're like kind of in the like lower part of the markets compared like historically, and so as we see the economy is recovering, like everything is restart, we're gonna reopen our economy, and we see this whole virus outbreak is slowing down significantly and is totally controllable. As long as we see that, as everybody sees that clearly, do you think the market gonna efficiently reflect that immediately, or do you think we are now like because of this uncertainty, we're like squeezing the actually we are undervaluing lots of assets. So like, what's a good point to like reinvest back into the market? And another little question would be like, compared to the SARS outbreak in China,
Right.
that we also see like significant amount of drop in the demand side, like traveling and the restaurant service industry, etc. But we saw a very clear retaliatory growth. Like after that, people start to spend money like a lot just in a short amount of time. How would you think that's going to affect this economy if they do? Yeah.
Well, I should say, so I'll start with the economy. I am personally surprised. I think everybody is at the amount of the disruption in the economy. It turns out that so much of this was just voluntary. And if you're social distancing and stopping, it's a lot more brittle than I would have thought. And again, that's just more Rob talking about. If you're talking about a good time to step into the market, and again, this is a personal anecdote. If you don't trade, if you don't know, oh, by the way, am I still displaying my screen? But I know guys who bet against the market rally right now. It's a solid I don't know. Nobody does. And if you're not in the business of committing or providing liquidity and trading, the best thing you can do is stay involved, especially with your perspective in the longer term. Because there will always be corrections, there will always be disruptions, and there's always going to be inefficient price discovery in this. And if you don't seek to pick the top or the bottom as well, and you keep a longer term perspective, then history and experience and our overall aspiration teach us that this thing grows. And if it doesn't, by the way, we're grabbing our canned foods and we're running for the hills, and I don't want to contemplate a world like that. And I'm sure, I know that doesn't directly answer your question, but it's also that anybody who tells you, oh, now's the time, come on, right? The other thing, last thing I'll tell you, because this is important for anybody who's thinking about the portfolio management side of things, about the value creation, about the business where place assets with me and I'm going to place them in the market. You're paid to take risk. You're paid to have an informed decision about now's the time in or out, focus on this strategy, this sector, this type of instrument over others. And we joke at NASDAQ in mind, if I did that, I'd be addressing you from Rum Point in Caymans, having called it a day about 10 years ago. Then the best thing I can do is just stay involved. I stay in, and it's been to the overall long-term benefit to do it. Are you thinking about trading as a business, Victor?
Yeah, kind of.
It becomes about what your thesis, your strategy is, your edge, your research, and then how you convey or market or sell that or explain it to those who put assets with you. So what's your thought? Let me turn the tables. What's your call from here?
I'm not sure. So actually, so we were like, like one of the investment club of Kobe, and we were talking about so right now we decide to sell like some of our company, like big companies in the banking industry, as well as like some tech industry, big tech companies, because our will would be like, if this keep going down, the whole market gonna go down, regardless, like if this it has a strong core business or not, especially for like right now the whole business landscape is down. So like no one even pays advertisement that much. Even everyone stay at home, you see the volume of using like those online services is increasing, but they are not actually profiting. So what our strategy, even we are not a trading club, some of us think that we should like pull ourselves out, and in this crisis, just holding cash. And then as we saw the market start going up, even we are not buying into the lowest of lows points, we're like, we can still like, benefit from this, like volatility or, yeah.
And is it a long-term investment strategy or trading strategy? Is it a market neutral?
Yeah, so figure out, yeah.
Yeah, and once you figure out all these things, and they lend themselves to to figuring out from me and the Rob standpoint. I don't trade for a living, actually work for a living, but the investment is just about staying in, and it has proven over time to be ultimately beneficial, right? That said, man, March 23rd, thereabouts, I know that there were people calling a short-term bottom and jumping in. I don't know what they've done since.
I see. Do you think so you think that if we are like geared towards trading side, or we want to learn, it's best for us to stay involved while we learn from the market, other than just like observe the market as an outsider, you think?
Two keys. First of all, nothing teaches you like being in, right? And it's been harsh, but it's that difference between trading and investing. One provides liquidity. One is net market neutral. Traders, for the most part, seek to be flat at the end of the day. They're going home with cash. They don't wear positions overnight. They're not owning long term. My favorite story, and I think I told this in January, it's not a trade. So I'm married to a Canadian, and my mother-in-law put $2,500 into our Canadian checking account. I don't know, dude, we bought birthday gifts or drove, we'd been good children, whatever. I'm like, what am I going to do with $2,500? So I bought 50 shares of Shopify, which I can do because it's New York Stock Exchange listed. Right? It was $57 Canadian. What's it, 800 bucks? By the way, that's a stock I can't figure out. Who can trade that? Who can call that? It's still my favorite story. It's 50 shares. It's not going to make or break, but it's about the net benefit of picking well-run companies with great growth prospects over the long term. Is your strategy for trading overall market? Is it equities? Is it U.S. focus? Is it growth focus? And is it one that seeks to own or seeks to be a risk-adjusted return market neutral? Once you figure all these out, then you'll get to your question of what's the bottom or what's the best way to express what I think is going to happen. I'm back to the same point and what I'm telling the executives of companies. Now, by the way, if you run a company, you're in for the long haul, and you're in your own stock and you're up to the neck. If we see the lows again, it will not be without precedent, which means it won't have a lot to do with you or the way you're running it or your business. So I think that will inform your question too. The big question, the big bet, the big trade it's feeling like right now in overall cash equities is, are we going to continue to rally, or are we going to roll over and retest the lows? And remember, traders are only trying to be right 51% of the time, but that's the nature of the bet that is happening right now. And for me, a little homework for you.
Thank you.
Yeah.
Rob, thank you so much for this.
My pleasure, guys. I hope I didn't talk your ears off and bore you to death. But
I'd like to say some of us will buy you a drink or buy you dinner or something sometime, but who knows when that can happen. But
I look forward to it. I'm saying that to every client, by the way. I look forward to the time we can all get together and have another drink in a non-social distance setting. But look, guys, I don't envy you what you're doing, but keep at it, man. You're doing great. And if you have any questions, please holler.
Thanks so much.
My absolute pleasure. Be well.
Bye.